that everything is really complicated when you look forward in what's going to happen with markets over the course of the year, what's going to happen with an economy over the course of the year. Despite everything that I'm saying, we're pretty optimistic about the economy when we look forward this year. These are three different scenarios with some detail about GDP and unemployment rates and the Federal Reserve and inflation. And the three scenarios as they go from left to right are soft landing, mild recession, and severe recession to the far right. And our outlook right now is higher odds for a mild recession at some point in 2023, so this middle one, where inflation slows but not quickly enough. The federal funds rate, the Federal Reserve hikes a few more times at the beginning of this year, gets the rate between 5 and 6%, and you get like 1 to 2 quarters of economic decline in the middle of this year. Not even for the entire year, actually not even a negative year overall for GDP. That would be, this is a 55% probability that we have right now on this scenario. So not even negative for the entire year of GDP, we've got it at 0.3% for the entire year. This would actually be extremely similar to what happened to the economy in 2001, very early in my career as an economist, where the economy declined. It actually wasn't even 2 quarters in a row. It was 2 quarters that were separated by a positive quarter. Consumer spending never actually went negative in 2001. It was an incredibly mild economic recession. The unemployment rate went up by 1.5 or 2 percentage points, which does translate to millions of job losses, which are heartbreaking and challenging. But this is not like 2007 and 8 and 9 and 10. It's a very, very mild economic recession. Equity markets went down a lot in 2000 and 2001, but it was because of the tech bubble popping. The story of 2001 was basically tech bubble pops, companies see that, they get a little bit less demand, they pull back on CapEx a little bit, some jobs are lost, consumer spending stays positive, and it takes a little while to recover. We're talking about a mild recession that's sort of along those lines in terms of the economy, consumer spending, yeah, it'll pull back a little bit, and but it's not devastating by any stretch. And that's a 55% probability, and I gotta tell you, we're moving that back closer to 50 with some of the data that's been coming out. And moving more and more back towards the soft landing, which as of right now officially, we have a 40% probability, which is still a really high probability that we don't even get those 2 quarters of decline, because we haven't really seen any kind of weakness in consumer spending. Yes, it's slowed down from stimulus checks and much lower interest rates. This year, the second half of last year, there's definitely slowdowns in housing and auto sales and some of those interest rate sensitive sectors, but other types of spending are still very positive. So we have the 40% on the soft landing, 55% on the mild recession. Math majors, that leaves me 5% for the severe recession, which is, severe recession would be, oh my goodness, we're all wrong about inflation. It's gonna resurge like it did in 79, 80, and 81, and the Fed has to crank up rates even higher. And I think that's an incredibly low probability, but it's still possible.